Forecasting Folly by Mike Adams. There are not many financial advisors in the business who still remember October 19th, 1987, or Black Monday. That day saw the single largest percentage drop in market history. As I consider the 2022 stock market, I find myself thinking back to the lessons that Black Monday taught me, not just about the market, but about the responses from so-called market gurus. Prior to the 19th, the talking heads said the Feds would raise rates. They said that the bull market that had started in 1975 had run its course and the economy was headed for a recession or even a depression. Stocks were overvalued and had further to drop. In fact, I heard one commentator say that there would be blood running in the streets. Every expert had an answer, and not a single one was correct. I do not know why the 2022 market has caved in, but I wonder if similar factors to those which were present on Black Monday are at play today. Let me give you a picture of that day in 1987. I had licensed in June 1986 as a stockbroker, and my book of business was between 1 million and 1.5 million in assets. As a rookie, I was making around 100 prospecting calls to new clients every day. I arrived before the opening of the market, 6:30 a.m. in Seattle, turned on my Quotron machine, a device that delivered stock market quotes electronically, and readied myself for the day. The bullpen was already alive with my fellow rookie brokers listening to the Payne-Weber market strategists on the Squawk Box. The Squawk Box gave us the company's predictions for the upcoming market, and according to them, Friday, October 16th had already been a shock when the Dow dropped 108 points. That Monday morning was forecast to open weak and probably settle down. Well, they were almost right. Payne-Weber had been pushing covered call writing, which they said offered the potential to achieve superior returns for the client by buying the stock and selling the call option. The company encouraged their use for conservative income accounts because the call would tend to generate additional income. The way Payne-Weber explained it to us rookies, it was almost like a dividend. In the previous weeks, I had purchased Chrysler stock at $52 per share and sold the $55 call for $2.50. If the stock got called away at $55, my clients would get a $2.50 profit on the stock, an additional $2.50 for the sale of the option. As a rookie, that sounded like a good deal to me. It had even worked well with other stocks I had bought and sold for my clients in the past. That day, the Dow opened at 2246 and plunged more than 100 points in the first half hour. To put that in today's terms, about 1,400 points. I sat mesmerized by the Quotron, watching the price of Chrysler decline with the market. After 30 minutes, the drop seemed to be coming to an end as the rate of fall tapered off. The Dow decreased another 50 points, 700 points today, as we watched. The strategists on the Squawk Box were still singing a positive song. I had not made a single dial to my prospects or clients. I was too fascinated by what I was seeing and a little mortified by the price decline in Chrysler. Instead of leveling off as the Squawk Box speakers anticipated, the Dow turned down sharply and dropped another 110 points. In the first hour and a half, the Dow had lost almost 10%. In today's terms, that would be over 3,000 points. At that time, I remember thinking it was like watching a slow motion car crash. The Dow suddenly reversed and began to climb, only to invert again and fall another 200 points. Once again, it rallied only to fizzle and plunge. The Dow would end October 19th down 508 points, cutting 25% off the index. Adding the drop from the previous Friday, that equates to about 10,000 points in the Dow today. And my Chrysler stock, it fell from $52 to $12. That day, I learned that the risk in covered calls is that the upside gain is limited to the strike price plus the amount of the option. The downside is only limited by zero. It was that experience which formed my strategy of only investing in stocks which have twice the upside as downside. But that is another story. October 19th, 1987 still holds a record for worst one-day loss in market history. And just as fascinating as the drop itself was the running commentary put on by the pundits and gurus trying to explain each rise and fall made by the market. It took several weeks for experts to determine what really happened that day. In the meantime, the talking heads had plenty of theories to fill the airwaves. The Fed is set to raise interest rates, spelling trouble for the economy. On October 19th, the market was telling us that we are headed for a recession and a strong bear market. The Fed is going to put us into tough times. There is little doubt about it. I listened to one mutual fund wholesaler announce that $1 trillion had been wiped out of the economy. He insisted that by the weekend, things would be so bad that you could hear a pin drop in Nordstrom. It was Christmas shopping season, so I suggested to my wife that Saturday we go to Nordstrom's, and she agreed. But come Saturday, the store was so packed with people, it was almost impossible to get in. I joked to my wife that someone must not have told these people they had lost $1 trillion. In reality, the events of Black Monday were a result of portfolio insurance. At the time, many brokerage firms and big investors had set up computer algorithms to protect their gains during a bull market. When Friday turned down, the algorithms reacted by alerting the traders to sell. In 1987, computers could not themselves make the trade. They told a human to sell, who would then push a button to trigger the sale. In this way, the portfolio insurance algorithms sent an order to the stock exchange to sell a 25 million basket of stocks. That process began on Monday morning with traders hitting the button to sell. However, the number of sell orders overwhelmed the system, and playbacks to the operators were delayed. Those playbacks were the confirmation that the order to sell had been executed. The operators, not receiving playbacks from the overwhelmed system, thought that their trades had not gone through. They hit the button to sell a second time, dropping another 25 million in assets. When that playback also did not come immediately, they hit the button again and again and again all day long. I suspect there are parallels between 1987 and 2022's markets. Computers analyze huge amounts of data, far more than humans are capable of comprehending. They use this processing power to search for patterns and determine a strategy for buying and selling stocks. And yet, as humans, our brains have a significant advantage. Consider this simple thought exercise. If a coin is flipped 6 times and it comes down heads, 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 that begins to look like a pattern. Were this to be true, there would appear to be a 100% chance that the next flip would also land on heads. As humans, we know that the odds are 50-50, and the pattern is merely coincidence. This higher level thinking allows us to understand that once in every 64 times a coin is flipped, the pattern will fall heads, 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 heads. It is foolish to bet 100% that the next flip will be heads. This illustration is oversimplification, of course. Computers looking for patterns in history see that on Black Monday, 1, the Fed raised rates in 1987, 2, the bull market was more than 8 years old, 3, the market had more than tripled since 1979. And 4, a number of growth stocks had quadrupled or quintupled during that bull market. The results were that stocks fell 25% in one day. Then the computers looked for other similar historic events, like the dot-com bust. There they see that 1, the Feds raised rates in 1999, 2, the secular bull market ran for over 20 years, 3, the market had grown more than tenfold since 1979, 4, many stocks increased 6 or 10 or 15-fold, and 5, some stocks soared in value. The result was the NASDAQ falling 78%. The parallels to today's market are obvious. But there are significant differences in 2022. Exodus Communications was a typical dot-com era stock in 1999. It had limited or no earnings, was hemorrhaging cash, but had soared to a market cap of $32 billion. Exodus was in such bad shape financially that it would file for bankruptcy in 2001. Companies in 2022 are seeing record revenues, record profits, and are creating record levels of cash. I am not convinced that the algorithms recognize those fundamental differences. There is no historical market data available for computers to evaluate about pandemics or their recoveries. I wonder if the computers are not once again mistaking coincidence for pattern. It is hard for me to understand why stocks with earnings that are doubling year after year, who are growing their revenues at 40% and are creating big chunks of cash, should drop 50% to 70% in price. It makes no sense to my human brain. It makes no more sense than a 100% prediction that the next flip of a coin will be heads based on flipping 6 heads in a row. In 1987, in spite of all the projections of recession and further stock declines, the market recovered about 33% of the drop in 90 days, and the remaining 66% before October 1988. In the longer term, stock prices grew to reflect the value of their companies. I am optimistic that this market too will return to the fundamentals. I am, of course, always legally required to say that past performance is no guarantee for future results. Mike Adams is the president and principal of Adams Financial Concepts LLC.